Today, I want to talk about how a major short seller is currently being margin called and how liquidity is gone. I want to explain how this will impact the overall market over the next few weeks and how AMC will also be impacted as a result. So stay tuned and let's make some money. Now I'll dive straight in with the key information. So, as QCap tweeted, they said the Icahn margin call is happening. As we can see, the Icahn Enterprises stock was down 25% on the day yesterday, and over the last month, it's down a whopping 62%. As Genevieve tweeted, she said this Wall Street legend was exposed on Twitter. Icahn is famous for being a barbarian at the gate, aka a corporate raider. But now the barbarians are clearly at his gate as the stock is down 62% over the last month. Now Icahn and Icahn Enterprises is something I've touched on over my last few videos. I think it's really interesting because Icahn is a very large short seller that's currently down over $15 billion over the last few years. Now I want to explain how margin calls currently have the Fed very worried about financial stability. As StockSense Frank tweeted, he said Fed officials at the policy meeting earlier this month expressed concerns about the risks lurking outside of the banking system, and minutes on Wednesday actually singled out hedge funds, which tend to use substantial leverage and may hold concentrated positions in some assets with low or zero margin. They also said that memories of the 2020 rout are fresh. Back then, massive volatility in treasury funds and in equities sparked margin calls among hedge funds and contributed to the Fed's decision to pledge trillions in stimulus. Basically, the Fed is aware these hedge funds are making very over-leveraged trades that have a very small amount of margin headroom. Basically saying these hedge funds are close to being margin called because they have low or zero margin, and a volatility spike could end up liquidating a bunch of different hedge funds. They also said there's a risk in our capital markets today about the availability of relatively low margin or even zero margin funding to large macro hedge funds. And officials have been asking about the current margin requirements and how a US debt default or a downgrade of the US's credit rating would impact the market plumbing, including the value of collateral. Basically, if the US's credit rating gets downgraded, then all of those US equities also get downgraded, and these hedge funds have to stump up way more collateral for their margin requirements. So I guess these hedge funds are just hoping that the US's credit rating is not downgraded. But as Fitch, the rating agency, has just said, the United States AAA rating may be cut by Fitch. Fitch has actually placed the United States' AAA rating on watch negative. Basically saying that if the US cannot lift this debt ceiling over the next few days, maybe even just over the weekend, the US's credit rating will be cut below AAA rated, just like it was back in 2011. Now back in 2011, that downgrading of the credit rating caused a stock market crash in the S&P 500 by 18% in just under a week or two. And that's why the Fed is worried about these hedge funds with low margin availability, because a spike in volatility caused by the US's credit rating being downgraded would liquidate tons of hedge funds. It wouldn't just be Icahn and Icahn Enterprises being liquidated, it could potentially be the entire hedge fund industry, including Citadel and many other large hedge funds. And the Fed have said the possibility of a US debt default has added a new and troubling element. And financial watchdogs are under pressure after having been blindsided repeatedly by instability in the bond market since the pandemic erupted. Now, this potential downgrade in the US's credit rating is very worrying for those hedge funds, because these hedge funds are also experiencing a number of current liquidity crises. Right now, liquidity in the overall markets is gone, as there's multiple liquidity crises impacting the wider market. Cash that these banks are holding is experiencing a liquidity crisis. The interest rate hikes are causing another liquidity crisis. There's a liquidity crisis in the housing market, and certain stocks like AMC are also experiencing a liquidity crisis. There's major liquidity issues in the overall market because these major banks like JP Chase are running out of cash, and therefore they're trading less and clearing less trades as well, especially with these higher interest rates impacting them too. But as Top G tweeted, he said, so even though there's a liquidity crisis, in the spur of a moment, Nvidia added almost $200 billion to its valuation. He said, can you imagine how much money that actually is? And he said, as a result, don't tell me AMC can't hit $10,000 per share ever. He said there's more than enough money for it to even hit $1,000 per share. AMC alone currently has a market cap of $2 to $2.5 billion. If AMC added $200 billion to its market capitalization in one singular day, that would be a $400 price gain for the AMC stock. And this absolutely could happen very easily with liquidations. Don't forget, Nvidia just added $200 billion to its valuation in one day with no hedge funds being liquidated at all. Imagine what would happen to AMC if even just one hedge fund was liquidated, let alone 10 hedge funds or even 100 hedge funds. AMC could very easily add $200 billion to its valuation or even more if all of those hedge funds shorting AMC were liquidated all at the same time and were forced to buy back and close out of their short positions. Nvidia managed to add $200 billion to their valuation just by simply increasing their Q2 forecasts, let alone what could happen to AMC if their forecasts were increased at the same time as hedge funds being liquidated. And as Rick Rule tweeted, he said investors tend to forget that a liquidity crisis in the near term takes down all ships. He said the sell decisions in a liquidity crisis during liquidations aren't seldom made by the investors or the hedge fund themselves. They're made by the margin clerk. And he said in a context like that, everything gets sold, if it has a bid or if it doesn't. This basically means that when hedge funds get liquidated, it's not the hedge funds themselves in charge of their own liquidation, it's the margin clerk performing the liquidation. And all stocks will be sold and all short positions will be bought back regardless of the price. These hedge funds don't get to choose how and when they get to liquidate their AMC short position and choose how and when they get to buy shares. The margin clerk just force market buys all of those shares all at once in the open market, which would obviously push the price of AMC up and up and up during a massive wave of liquidations. And as Enduring Winter tweeted, he said, here comes the liquidity crisis that many of us have been talking about for years. He said, this is like watching a slow motion train go off into a cliff. Now, something else that would also drain liquidity from the markets is the Treasury Department issuing tons of new Treasury bills if the debt ceiling does get raised. This article says the Treasury Department could issue $700 billion in Treasury bills within weeks of a debt ceiling deal, draining liquidity from the markets. And that's because the Treasury will have to replenish its cash balance after the debt ceiling is lifted. The US Treasury currently has under $40 billion left in cash reserves. As Wall Street Silver tweeted, he said the US Treasury is so low on cash and has used up all of their tricks to delay spending, and then there will be an avalanche of new debt issued to try and catch up, especially as all of this new debt will be raised or issued at over 5% interest rates, sending annual interest on that debt to over $1 trillion per year. And especially because all of this new debt will be issued or raised at over 5% interest rates, sending annual interest payments on the debt to over $1 trillion per year. I also wanted to quickly talk about AMC's short interest and how it's supposedly decreased. As you can see, AMC's legally disclosed short interest has reduced from 134 million shares down to 105 million. But as Robert tweeted, he said these hedge funds are using options to make it look like shorts have covered with no real price action, reducing the short interest in the process. But all that really does is increase the risk for these shorts because it means they've taken out a larger derivative position and once again doubled down on their short position. So what we can see, obviously these hedge funds are just using options to simply hide their true short position or to hide their legal short position and make it look like they've closed out of some of their shorts. Obviously, we know these shorts haven't closed out because the AMC price has continued going down. There's been no price action that would evidence them actually closing out of shorts, especially because these hedge funds are still raking in millions of FTDs on AMC every single day. Therefore, they've clearly just tried to hide their position to make it look like they've closed out of and to cause panic and fear when obviously they haven't. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.